Good evening, ladies and gentlemen. A very warm welcome to all of you to our discussion on early stage investing in India, which now has the world's third largest startup ecosystem behind the US and China, and more than 50 unicorns, which, as most of you would know, are private companies which are valued at more than $1 billion. Alongside this, we'll also talk about VC funds as an investment asset class, which has been moving beyond the traditional domain of institutional investors and is starting to see some real interest from private investors. Interesting factoid here that Yale University's endowment has more than 15% allocation to VC funds, as I understand it, and has generated returns in excess of 30% over more than 3 decades. I think that's something quite astounding. And we'll talk a little bit more about that later in the conversation too. Joining us for this discussion are veteran stalwart investors Rahul Chandra in the jacket and Bala, Srinivasa, who's not in the jacket. The founders of Arkam Ventures, an early stage fund focused on Middle India, and which was one of the top 6 new VCs in India last year by deal number. A little later, we'll also hear from Arjun Ahluwalia, the founder and CEO of Jai Kisan, one of Arkam's portfolio companies, who's doing something really interesting in rural finance. I am Shiv Gupta. For those of you who don't know me, I'm the CEO of Sanctum and your host for the session. Let me start with a little bit more of an introduction of our guests. Rahul was one of the earliest VCs in India and has also spent considerable time in Silicon Valley. He co-founded Arkam Ventures in 2005, where he invested more than $100 million in 15 companies, including the likes of Equitas, Spandana, and Topper. He's also the author of the wonderful book, The Moonshot Game, Adventures of an Indian VC. Delighted to have you with us, Rahul.
Thanks.
Bala, our other guest, who is a Wall Street analyst, Bala Srinivasa, and a startup executive before becoming a VC. He was previously a partner at Kalari Capital, another heavy hitter in this space. And prior to that, he was part of 2 successful analytics startups, one of which, Amba Research, was acquired by Moody's in 2013. So wonderful to have you, Bala. Thank you for joining us. A note to our guests before we begin, that we expect the session to last for 90 minutes. And we'll focus on topics that our investors typically ask us about. In fact, most of the people attending here are existing or potential investors. However, do feel free to ask further questions during the session using the Q&A feature. You should see it on your screen. And if you put it through to us, the panelists will be able to look at it. And then at some point that seems most appropriate, we will cover it off. We'll try and group questions if you get too many of them. And we will try and cover as many as possible in the course of this session. We will, of course, at the end of the session also see if there's scope for some further Q&A. So with that, let's get started. Perhaps we can just start by asking both Rahul and Bala, about their journeys of investment and entrepreneurship that brought them to the point where they decided to set up Arkam, which I understand means limitless in Sanskrit. So would you like to kick things off with that, maybe Rahul, and then Bala?
Sure. Thanks, and great to be here on the Sanctum Fireside. Thanks for having us, and wonderful to meet all of you. Good afternoon. So quickly, we'll cover our respective journeys into Arkam. My journey started in Mumbai in '98 when I was the first employee for a US venture fund called Walden, which was the first India-dedicated fund that got raised from investors participating from Japan, US, Harvard endowment, much like Yale, as Shiv mentioned, was one of the investors. Invested in Indian startups when venture capital was actually a very alien name. Most people didn't understand what we were. Things progressed a bit with the .com boom, at which point I moved to the US, to Silicon Valley with Walden to invest in Silicon Valley startups. Also did my business school from Berkeley at the UC, University of California. And by 2005, India looked very attractive from a domestic economy growth. I moved back in 2006 after starting a fund called Helion with 3 of my partners in 2006. And again, Helion was one of the early funds to be backed by global blue chip LPs. And Helion's first fund, looking back now, is a top decile fund with exits like Pubmatic, Make My Trip, and fund size was 140 million. We raised two more funds. Both did spectacularly well. Personally, I invested in some companies that Shiv mentioned. My focus was at that time going back and forth between technology and non-technology. And in non-technology, I focused on financial services. And interestingly, things converge at some point. So we'll come to our thinking around Arkam later, but I'll pick up this thread later on why that really played a big part in understanding what we knew before we started Arkam. Track record wise, we finally get measured in numbers. So the looking back again, track record's been very decent. Invested roughly 100 million at Helion, not counting the Arkam investments. Returned about 120. There is a multiple on the invested capital of about 6.5, which translates to about a 27% IRR. And some of the companies have gone public, like Equitas, Spandana. Some are likely to go public soon, like Shubham Housing, which is a very large housing finance company. Some got acquired by PE firms like United Lex. Some have got acquired by strategics like Flipkart and other global tech companies. So net seen 3 venture cycles. This is probably the 4th one that we are seeing. And before we go on to the Arkam thought process, I'll hand it off to my partner Bala to hear more of his background.
Thanks, Rahul. Thanks, Shiv. So, dial back to here. So Rahul and I actually.
Your audio is crackling.
Switch it on and off, perhaps.
Let's see.
Is this better?
Much better, thank you.
Okay. So just to dial back the years, which is what I was trying to say. So Rahul and I went to BITS Pilani together. That's how, so we've known each other for more than 20 years. I started my first 8 years as a Wall Street analyst, as Shiv was mentioning. And it's a funny thing, you start out in the 90s as a Wall Street analyst, which culminates in the dot-com crash. You've learned a lot more than you're probably given back. So at that point in time, the internet was just getting off. Most of you won't remember a web van, which was the ancient ancestor of a Big Basket and an Instacart in the US today. So I had a chance to actually evaluate and write research reports on companies like that. But post that, joined 2 startups, and this is a very relevant part of my background because today when you invest in startup companies, I was the 3rd guy in my first startup, and you get a very nuanced sense for what startup teams are like. So that was my first startup, which we kind of grew to about 30 million ARR in New York. It was an analytics company. In 2009, I happened to be in India and ran into one of Helion's portfolio companies, a company called Amba Research, which was about $10 million in revenue at that point in time. And again, paths crossed with Rahul. And at that point, I joined Amba Research to actually run all of their revenue, which is sales, marketing, and product. We were able to grow it to about a $40 million company, and then we were acquired by Moody's for a reasonable exit of $100 million in 2013. Exits were hard to come by at that point in time, as Rahul would attest. Joined Kalari after that, and I was one of the 4 partners at Kalari. I spent a lot of time actually in fintech at that point in time, and in supply chain tech. So some of the companies, actually Upstocks was one of our investments, which Tiger is now invested in. The Zerodha competitor you're all familiar with. Metal was an exit that we had to a US investor, and a bunch of other firms. So I was on 9 boards, overall track record, 26% IRR. And Rahul and I got together in early 2018 with a very specific idea for starting this fund. So that's a quick background.
Thank you very much, Bala. I guess, Rahul, you wanted to come back to the question of Arkam. Thank you for sharing that. It really allows us to let people see the breadth and depth of experience that you've had in this space over different time periods and in different areas of the value chain. So it's good to see that. But yeah, back to you. You're on mute.
I mean, to underline that, I think the point is three cycles is that as every cycle is a boom and a bust. Bala's also talked about the boom and the bust. And I think the point we are at right now, there are questions about, how hot is this and how frothy is this? And I guess our response would be that we have seen these cycles before. We have known what not to do, what to do, how carried away to get, and how not to get carried away in these cycles. But, that's really the investment experience that plays into whenever you look at a cycle, you have to make the most of it. Cycles are good, bubbles are good. They are the ones that give extraordinary returns. And when we started Arkam, Shiv, we were looking at this almost 2 years in advance. So we saw this frothiness coming because what we were seeing at the ground level, meeting founders every day, was seeing a very subtle shift in the way the quality of the founders' thinking was changing. They were beginning to see India in the light of the Indian consumers' needs, so finding technology solutions, and most importantly, building it on top of the experience they had gathered at other startups. So the first 10 years of Indian venture was, I would say, more of first time people coming in, trying to do a startup, work through the system, solve problems. And they had, invariably created all this, cadre of people who were actually learning while these businesses were, failing or flourishing. But suddenly we had this mass of entrepreneurs who came out with, their, the first job being a startup, and they know the rigors, the longevity that they need to have, the failure rate that they must expect. And their approach to India was, different in two ways. One was that suddenly we are going to build a small company, we'll tinker around for 10 years, change dramatically to a 28-year-old telling us that they will build $1 billion company. I mean, that language we had never heard before. We had always heard that, we don't know and we'll try and find a buyer, but we'll make sure you don't lose money. That language just went out of the window. So this was more of, let's build global sized companies. And that was music to the ears of global investors because, investors sitting outside India is not looking at India just because they're Indians. They're looking because they have a global set of opportunities, India being equally attractive compared to a China or the US. And they're allocating capital. Like you said, a Yale allocates capital across the world. What they're looking for is diversification. Like a China shouldn't crash with India, India shouldn't crash with the US, etc. Although they're quite linked together, but at least that's what they're looking for. So the biggest shift for us was this entrepreneur who was beginning to say, $1 billion, large ambitions, understands the Indian consumer, and grew as a tech user. He was a tech native. She was a tech native from the time they went to high school, right? So they grew up on web tech, went to college, went through a startup program, entrepreneurship, wrote a business plan in college, came out, worked at a startup. And now we've got these dyed-in-wool, entrepreneurs, even though they're young with massive ambitions. Second one was, Bala's financial services exposure and my exposure, Bala's exposure into companies which go into, middle tier India, selling to a consumer class, which is not very visible in the circles we move in. But if you invest in a company that sells to them, you walk the village streets, you go to a rural center where all these customers aggregate, and you talk to them and you start understanding a few things. So Bala and I had that common learning of identifying the fact that, this bigger or biggest consumer class, which sits right below people like you and I in terms of economic purchasing power, is actually, it's a mistake to ignore it. In fact, at Arkam, we should focus on this massive purchasing power. It just needs to be, handled and addressed differently. This is a consumer class that buys shampoo sachets. They buy it, 4 times a month. Instead of buying a bottle, they will come and transact a lot more frequently. And you just can't have the same industrial structures that have been, been built from European US models and have been catering to a consumer that's, fairly well-to-do and has long lifetime value and, is not taxing to the system. So the marginal cost of sale to this customer has to be, marginal cost of servicing rather has to be low enough to be able to make money. Otherwise, you go from a top-tier Indian economic class of 25, 30 million, and you go to the next 400 million, you're looking at potentially killing your business, because you will be bled dry, because your customers are now much smaller ticket size customers. So do you rethink your industrial structure? Do you think and do you replace the old structure with technology? So that's what at Arkam we're thinking, that you have to rethink industries which are essential and core to the economy, and you have to think of it in terms of technology. And that technology has to be ground up. It has to be a full stack technology. You're not building just the customer support piece. You're building everything from the product to the customer acquisition, customer servicing. Everything has to be built in tech by the team that's able to see this problem through and through. So that's the new industry structure that Arkam is proposing to back. And we're looking at only 4 sectors. Those 4 sectors for us is about 70% of the wallet share of this 400 million population.
Yeah, so I mean, some very interesting observations there. I think it's maybe half a generation in which we've moved from the traditional mindsets that we might all have grown up with to this aspirational, ambitious tech native who wants to conquer the world, right? It's maybe a half generation, but it brings me to the point that you talked about the cyclical element of what you've seen, but obviously there's a big structural story that's taking place in India. This itself is an example of that, right? The nature of the entrepreneur who's out there today and what they're trying to do. Now, I want to come back a little bit later to some of the points that you made on the micro, the choices that you've made around the 4 sectors and how they account for 70%. But if you could just talk about the macro a little bit. I also want to acknowledge that we started seeing some questions coming through, but we're going to be talking about valuation and the frothiness a little later, so we'll come to them in a minute. So on the macro, Rahul, I mean, they say that venture capital plays a transformative role in economies by providing capital for new technologies that may otherwise go unfunded, right? Mm-hmm. And it does appear to be happening, right? And the government appears to be taking some steps at least to recognize that this is a big structural story. So what are the big things happening in the startup ecosystem at a macro level that kind of support, being in this space?
I'll take a few points that come to mind. I think this is more of we'll think through this question, but what is very positive for us as Arkam, Shiv, is that we are now seeing more and more startup funding getting what we call democratized. When I was doing Helion, Helion had to do its seed round and then come back for a Series A itself, and then do a Series B itself. There were no investors. There was no ecosystem of investors, which meant that we were trying to validate our own thesis ourselves. Right? We did the seed. We saw some numbers uptake. There was no third-party validation, no third-party interest that we were really seeing. And that was just paucity of capital. There wasn't enough capital to fuel the entrepreneurial energies of a very large country, and country that is going through a massive transformation. So the biggest change we're seeing is this early stage first check democratization, where when Arkam looks at a company, it's already raised some capital, it's got validation. Very obvious question is, if you are a Flipkart executive, did you raise money from the Flipkart CEO? And then you come to us, right? Because what is the best form of referencing, or the proof that you are a top tier employee at Flipkart, you are a valuable asset, is that your ex bosses will fund your startup. Those are things that have begun to happen. There are these very interesting cues we are getting from the system in the form of capital. The kind of people that back, kind of people who understand that problem have gone and backed a startup in that space. So, which the form of validation was non-existent. We had to actually pick up and talk a lot about the problem earlier, ask for industry folks to give us their opinions on the business. So I think that not only creates a massive deal flow for us. So no matter how frothy the system is becoming, what Bala and I are realizing is that we are finding enough quality deal flow, which is available at the sweet spot that we want it to be. So volume has happened, right? Quality and volume both go hand in hand. And right now in India, it is by and large a high quality volume ecosystem that's getting developed. So that is the biggest one that's changed over the last 10 years. Bala, you want to add to that?
Look, the questions about macro, I think what Rahul pointed is a very big change. But the second thing that kind of fits very neatly with that is what is different about startups that are getting formed now versus 5 years ago. Okay, because if you're simply going to say, hey, look, these guys are all much more ambitious, you scratch your head and say, okay, ambition alone doesn't cut it. What is different? Almost every company we have invested in this fund so far, the 6, actually wouldn't have existed 5 years ago. And that is a very important point. That the point is that they wouldn't have existed 5 years ago because all these companies are leveraging certain technology stacks in India that is allowing them to build business models that solve for some of the issues Rahul talked about. These are low price, high volume. You need low cost to serve. You need to have your overall business model and unit economics in such a way that your cost to reach and service millions and millions of customers needs to be a lot lower than building brick and mortar, having feet on the street sales force. So one of the biggest changes is today you can build very rapidly scaling companies that have been formed 3-4 years ago that can use technology to solve for problems in large markets like financial services, healthcare, logistics, where these companies can scale profitably in ways they couldn't 5 years ago. So I think that's a very important change which anchors what this fund is all about.
And the reason why
I think it is.
Yeah, I mean,
Sorry,
quickly, the reason for that is that there are, India is unique because some of the technology rails that are there in India do not exist in any other country in the world. There, the startups actually have to rebuild everything from scratch, payment, identity, data, storage. Here, thanks to Aadhaar, UPI, there is at least a great starting point. I mean, now you can verify anybody's identity anywhere in India if you want to. Take money from anyone, anywhere in the country for almost free. So the reach of a startup is suddenly expanded because you want to get a customer, take a payment, validate the customer, service the customer. So I think it's also this change in the last 5 years happened thanks to something that has been done uniquely here.
Quite right. And I think the entire value chain, participants along the value chain are contributing to this big force multiplier that's being created by introducing solutions, technology solutions at all points in the chain, which then people are leveraging and getting a sort of non-linear outcomes, which is, I suppose, what we're seeing. We've got a few questions. I want to address one question, Rahul, and it's addressed to you, but Bala can also pick it up. I guess it goes back into this is from Mr. Rawat. It goes back into the question of Arkam's business thesis and philosophy. So you talked about Middle India and you talked about the 4 sectors. And so maybe you can just delve a little deeper into the sectors and see where the opportunities and the thinking behind that. There is a question from Mr. Nihal Singh, which is around the frothiness of valuations and pre-revenue companies getting multiples on the basis of what we do not. And we'll address that in just a few minutes when we get into just talking about what's happening with valuation. So maybe you could just start with go back into the hypothesis of the Middle India story, and then we can move on from there.
Yeah. So we have 4 sectors that we are focused on: financial services, food and agri, healthcare, and logistics. And in these sectors, we have scoped out the market. There are at least 5,000-6,000 startups, and obviously new ones getting started continuously. These are not sectors that are, very unique or, very outside, some other investors. Because if you look at a list of co-investors, they are the Accels and Sequoias of the world. So it's not like the other investors are not looking at this. The difference is that we are over-focused on this at the cost of some other sectors, which we feel are not going to generate, equivalent returns. We feel that these 4 sectors are so deep that we can look at companies coming out and addressing, massive markets. Like Jai Kisan addresses a $300 billion market. Small Case has an opportunity to create an entire AMC company with a new product for investors in India. So those are multi-billion-dollar market opportunities that we are able to pull out from these 4 sectors. And we have, we've not even gone to logistics, for example. We're looking at a few companies there, and we have enough high quality deal flow to select from. On an average, we look at 200 to 50 companies a quarter. We end up doing 2 investments, 1.5 to 2 investments a quarter at an average run rate. So last year we invested in 6 companies. This year we will do 7 to 8 companies. And the idea is to take this pipeline of very high quality founders and take it through the investment process, take it to the investment committee, and then get into a check. It typically ranges from 15 to 20 crores as the first check we budget. Additionally, from the same fund, we will budget about 1.5 to 2 times of that amount to do follow-on investments. So our strategy is not a one check strategy. It's not the idea. The idea is not to find a company and just do it once. Idea is to find the right companies and then continue to build our positions in those companies, maintain our positions, and have a very chunky collection of highly valuable companies in the portfolio. So the idea is a portfolio idea. 18 companies at the end of roughly 2 years from now. We've already had 1 year to build that. So we are 1/3 of the way down. 12 more companies to be added out of another 4,000 or 5,000 companies out there. And to handpick each of them and to make sure that they're all addressing large, massive markets, using technology, addressing the customer segment we talked about. And last year we deployed about 80 crores. This year we expect to deploy about 150 crores because we also have follow-ons, of our pro rata coming through from the last year into the companies that have successfully raised the next round. So both included about 17.5 million in new investments, 2.5 to 3 million in pro rata follow-ons from the past investments.
So Rahul, look, there are you've invested in 6 companies: Crazy Bee, Jumbo Tail, I have a list here, Science Z, Small Case, Jai Kisan, and Best Stock. I think 3 of them have had follow-on rounds. 4 of them now, I think, at multiples of the initial investment. I guess maybe a good time to just address this elephant in the room around where valuations are. We've got 50 plus unicorns, 3 decacorns, lots of whatever the 100 million category is called also alongside. And this is projected to grow to double in the next 2 to 3 years. Mm-hmm. And one of our guests also asked us a question. Tread1, a fitness tech startup, I don't know if you've heard of it, got acquired by CultFit for $32 million. It was pre-launch, no revenue. So could you kind of just put some of these valuations into perspective for us, kind of how to think about some of this, what's really going on, how much of it is structural value creation, how much of it is maybe a little bit of exuberance, which may be getting ahead of itself. Maybe even just talk about 1 or 2 of these companies. Maybe you could talk about one and Bala could talk about another of the companies you invested in.
Of the companies you invested, sure. I mean, I'll give a cover note on the valuation. My thoughts, Bala can add also to what his thoughts are on the valuation. But see, the question earlier that was written was about bubbles, right? Valuation bubble. And I said valuation bubble is a good thing. As long as we are keeping our nose to the wheel, right? If the idea is to be a very momentum-oriented investor, then any deal is a good deal at any price. And that's not how we think. So as investors, that's exactly the judgment we have to apply on where do we draw the line in terms of what we think is the fair value, even if you were to take the market exuberance factor in it. Are we over exuberant or are we, just exuberant? I think that's the line we want to take. And I mean, to be honest, we have said no to a few companies and we have lost a few companies because of exactly this question. The good news is that there is your own portfolio also that goes through these valuation markups. And valuation markups are not happening in isolation. They're happening at low dilution to existing investors and to the founders. So they can raise a lot more capital in the future. The capital structure is actually very, very well protected because it's not like you've given up very early on, you've given up 40, 50% of the company. So you have a lot of runway to raise more capital as you build value. as long as you're raising a big round, as long as, some investor in the US is thinking of, let me write a $20 million check into an Indian company. The Indian company has $20 million to build, right? So again, relatively speaking, it has a very big impact on the market, because an Indian company that's not able to raise money is, has less capital. But the fact is, all that money is coming into the Indian ecosystem, and it is building for India. And presumably these are good founders. At the end of the day, there is a selection process, and the news is always, looks like the same thing is happening too frequently and to everyone. In reality, it is happening to very few companies. It's just that these are such striking news points of bigger checks, and the example of the company that got bought, that they look like they're much more prevalent than they truly are. So the good news for us is that this is the pull on both capital coming in, valuations going up, founder capital structures being well protected. But also, Bala and I are very convinced. We look at companies every day and night, and we find that there is more than enough opportunity, which is only growing, which is not yet, which is, everything, like I said, is not overvalued. So we find enough opportunity that is fairly priced, has very high potential, big market. So we are not at all in that sense. And that's what I also meant by volume. The market is so massive now that, if even 10% is getting overvalued and crazy, then the rest 90% is not, like, it's not meant to be funded. So you pick the right ones from the top 10%, and in the 90, you find, like we said, we have to do 12 companies for this fund. So it's not, it's not a big challenge to find, fairly priced companies and 12 of them. So we are, I think, looking at a market which has repeated for us 3 times over. I mean, valuations went like crazy in 2014. I think $12-15 billion got put in 1 year. Last year was a $20 billion venture money into the Indian markets, which is massive. But to put it in context, Jio raised 20 billion, right? That's all. The entire venture funding market was raised by one company, which is Jio. Even though it's a part of a listed company, but it's a tech opportunity reflection. If somebody around the world thinks of Jio as the bellwether of technology option in India, then all these are also part of the same opportunity pool. So those are my thoughts, Shiv. I'll would love to hear Bala's thoughts, and then we can cover the companies.
Sure.
Nothing much more to add, Shiv. So why don't you go ahead? Yeah, I think.
Yeah, I guess the point is that the size of the market itself and the way the ecosystem has evolved over the last 5-7 years allows this amount of capital and more to come to be productively deployed. You have to be selective, of course, and there will be exuberance. I mean, we have 0% interest rates in most parts of the developed world, and liquidity is going to be there, and that will add, I suppose, to amplify anything that's happening. But it's good to know though that I guess you can cover off talking about 1 or 2 of your companies now, if you like, before we then get into
Like, I mean, I'll give an example of small case. What we again did last year was a muted market. It wasn't as crazy as the last 3 months we have seen this year. We decided to lean more towards Series B investments, or companies which had already raised Series A. So valuations were in the 30-35 million range, and so about 200 crore odd. That's our cap. Actually, we don't go beyond entering a company at a valuation higher than that. And what we're looking for at that valuation is a lot more validation and proof points and competitive moats to have happened than we would look at in a Series A. And Series A valuations are currently at about 15 million, roughly 100 crores. And the idea is that between this, you will find companies which have different proof points of execution, and the team actually playing out well, markets really being there, customers responding. So we tried to lean more towards the Bs last year, and this year we're doing more As. So we were, I think, very careful in picking up companies. Small case, we entered at a $35 million entry valuation. and they raised about 13 million along with the DSP family office. We co-invested, and this company has grown 4 to 5x in the last 9 months. Which is again, you can question if that valuation was underpricing the company or overpricing the company, right? The growth makes the difference. If you enter a company at a high point and you see a 100% growth, that is not good enough. I mean, 100% is not good enough in a year. So you want to see higher trajectory, steeper trajectories to justify that growth cycle. And Bala and I were chatting this morning only about about this point, that what we are finally seeing in our portfolio are category leaders for whom, if you have the right execution, we are going to end up owning categories. Small case is a category. Basically a category is a market leader. And going back, Make My Trip, which we funded, was the first investment by Helion, has remained a category leader for 15 years. 70% of the market is still Make My Trip. So, that's what we are, I think, in terms of when we think category leaders, that's what we think about.
Right. Bala, would you like to talk about one of the companies as well?
I'll use this company and try to stitch together everything we have talked about. Okay, so if you take this company, Crazy Bee, I'm still trying to communicate to the audience what is different this time and why these companies can become category leaders in much shorter periods of time than when, for example, a Make My Trip was invested in. That is what the environmental change is. Okay. So somebody like a Crazy Bee, when we looked at them, they were doing about 10,000 loans a month. Okay. In 6 months later, they started doing 50,000 loans a month. And we said, whoa, there's something going on over here. Okay. This is a company that provides small ticket loans that could not have existed 3.5 years ago, because the entire app is built on Aadhaar, UPI, eKYC, right? They acquire customers at 350 rupees cost of customer acquisition, while a typical bank acquires a customer at 7,000 rupees cost of customer acquisition. So one of the unique things we look for is there an amazing unfair advantage this company has in allowing that scale? Okay. So in 3 years' time, Crazy Bee last March did 1 million loans a month. They did 700 crores in revenue and 120 crores in net profit. So when we talk about category leaders and looking for companies for Middle India, we are looking for 3 things. We're looking for founders who understand Middle India, technology that can give them that unfair competitive advantage that drives profitability and revenue. And we are really looking for business models that can operate very differently than existing markets. And when you look for this in 5 of the largest markets in India, 4 of the largest markets, you will see the kind of outcomes that is leading to, the kind of economic returns that we look for. So that's the Crazy Bee example.
I think that does stitch together all of those points pretty well. Allows me a segue into a VC tongue twister. Do you find founders, or do founders find you? I understand the VC space has more than 520 active players right now, but we also hear that it's not really that deep, because most of the action takes place in the top 10. Now, of course, one can say one is self-interestedly positioning Arkam in a particular way, but if you can just help our guests kind of understand how that space is constructed, and more importantly, how do you find these founders, right? And how do you select them? And then how do you work with them to get, like you said, since you're thinking about category leadership, I'm sure there's a lot of strategic thinking that has to go into that. So if you could cover off these points, be very helpful to understand the space better.
I'll go for it.
I'll give you a view on that. I'll give you a quick example. When Rahul and I were sitting down for a couple of our companies that were going for follow-on rounds, we got on the whiteboard and we made a list. Who are all the companies these guys can raise Series B from? We went past 9 names. We've been in this business a long time. And after the 9th or 10th name, you suddenly fall off a cliff in terms of companies that can write meaningful checks, companies that founders want to work with, and companies that external investors will view as validating this company's investment into which they want to come in. So as GPs who have come from two of the largest platforms, what's allowed us to get off to a very fast start on this fund is, if you look at our co-investors, it's Axel, it's Sequoia, it's Nexus, it's Premji, it's TPG. These are all folks that know us, and they take the companies we back very seriously because they believe there is a certain amount of homework, there's a certain amount of validation of the GP's track record that's reflected in where they are. So that's point one. And point two is, I think there's a lot of activity at the seed level. Many of you on the call, anybody nowadays writes a 10, 20 lakh check as a seed company. So the challenge for a startup is not getting seed money. The challenge is, can you go beyond seed in terms of showing traction, aligning yourself with somebody who can work with you that can then help you scale? And at least I don't think there are too many players in that spot. And that is where the biggest opportunity is, which is why we even started a new firm, because we didn't think we are getting into a space with 100 VCs who are writing, quality VCs who are writing Series A, Series B checks. So I think you see a lot, you hear a lot about lots of VCs, lots of funding, but we would argue if you look at even the LP base of these VCs, you can see where the filtration happens.
Yes, and I suppose I don't mean this to sound controversial, but if you look at funding rounds and ongoing funding rounds and whatever gets reported, you keep seeing the same names coming up over and over again. And in a sense, it becomes a club of sorts. And if there is a origination advantage in that, great for the incumbent, I suppose. So let's just move on to some of the questions that clients have been asking us, and then we can come back to some of these things because we have a list of questions to go through, which bring us back to this as well. But first, you talk about a 27% IRR kind of track record over all the investments you've done in your investing lives. Looking ahead, and this is a question our clients ask us a lot, what return expectations are reasonable for investors across the life of the fund? And also, what has been the general experience of investors in funds that have been set up in the last 10 years? Now, I asked this very carefully because obviously, when the whole ecosystem is changing over the last 10 years, what happened then may not reflect what's going to happen in the future. But since we get asked this question quite a lot, and you have some vintage already of some successful funds, it would be useful to just maybe comment on that as well alongside.
So I can take that. The first part of the question was, what is the expected rate of return for this asset class, right? And I think the answer to that is driven more by what should clients expect. As expectation is borne by a middle ground, right? It's neither expecting too much or expecting too low. What's the kind of reasonable number to expect? Now, the good thing that's happening here is that there is no dollar depreciation. We are investing in rupees, we are reaping in rupees. So the currency risk is not there. We are looking at comparable assets in India. So we are not talking about multi-country, asset choices. We are only looking at what else is available in India that gives an IRR of that kind. And one caveat before this, I didn't look to invest in Zomato, but I went and met Deepinder for, getting his views on some things. And he was talking about $1 billion valuation round that had happened in Zomato. And it had got stuck there because no new investor wanted to value it at more than $1 billion because they felt that the $1 billion was like a high point. Stayed on, became difficult for them to raise capital at valuations lower. They came out of the hump. Now the valuations are growing in multiples of billions. So this business is actually, you have to think about that as the fundamental of this business is that it, let's say 1/3 of a portfolio gets to, to a high point mark, $500 million to $1 billion. After the 7th year, 6th year, when they take, whatever time they take to get there, the increments are significantly larger than all the increments combined up to that point. So it goes slow for 6 years. There is, slower valuation markups, and then there are significant markups. And the bubble part of this is that 6-7 years is now shrinking down dramatically. It's becoming 3-4 years. And that may go shifting between 3-4 years to 6-7 years based on how the cycles are. So, if the bubble is not there, it may go back to taking 6-7 years. If the bubble is there, it may take 3-4 years. So the IRRs will be spiky. Overall, I think to net all this caveating, I would say that the moderate expected rate of return for investors is in the 15 to 20% range. The vintage for this fund, helps us kind of project a better return than that, because we are in a upward cycle in terms of deployment and valuations. So our view is that 25% is, a fair expectation on VC asset class. Gross and net, I'm not doing it. Is a bit of fine tuning, but that's a 1.5 to 2% difference on IRR after fees, etc. But somewhere in that range would be a for this vintage, there would be a fair expectation. That's what we are also carrying forward. But over long periods, like 10 years, going back to your second question, 10 years back, what happened was, obviously we talked about how the markets changed, and we're looking at the rear view mirror to look at the driving. But the growth rates of these companies, the adoption of digital, the number of consumers that are consuming tech in India, it has grown 100x, thanks to Geo, thanks to UPI. You just look at a country 10 years back, if you just look around India at that point and you look around India now, the number of people's lives that technology touches in India now is far, far more than it was 10 years back. So we are in a worldwide, we are in a new asset class, which is technology, right? This is not VCPE or anything. It's technology. That's the asset class. And technology is what's really taking all the growth lever from this massive adoption, both at enterprises and consumers, which is unprecedented. So it is one of those times where technology becomes technology used to be enterprise technology, which would be like a router or a security box, which goes into an enterprise, or a piece of software that goes in an enterprise. That had a certain adoption and growth rate. What we're talking about now is this very virtuous cycle of consumers adopting technology, and enterprises that serve them using technology. And the more the consumers consume, the richer the enterprises become, and the richer they become, the more they spend on technology. So that's a technology virtuous cycle that's going on across the world. Wherever there's a large population, it's even better, like in India, because what it gives you is an additionally large market to continue to invest behind. And that's why people end up paying the valuations that they pay for Indian companies. So I think we have had two things, Shiv. One is that the asset has got repriced. This opportunity was there before, but certain things changed. Now it's apparently clear. So global investors gave $20 billion valuation to a Flipkart, which was, I think, the first or second highest valuation for an acquisition worldwide after WhatsApp. Why did investors pay so much? Why did Walmart shareholders an acquisition of a $20 billion asset in India, where all the challenges exist that we know of? And that is the adoption rate, the purchasing power, and the sheer volume of consumers that exist in India, and barring China, no other country in the world. So I think that's what has happened now. It's certainly got repriced. Technology is the asset class, and I think that way these cycles are reflections of things where a lot of money comes in. At the same time, it's part of a bigger macro flow, of course, where a lot of liquidity has happened in the US. But I think net, we believe that the technology opportunity has got re-rated, and India is one of the biggest markets to have that re-rated.
Comes back to that structural opportunity that gets unlocked once the ecosystem starts, creating the infrastructure required to give you that scale and that multiplier. Comes back to that, I said. Just for all of our guests, many people have been asking about the 4 sectors which we've not explicitly mentioned. So it's in the chat. I'm taking the liberty of calling it out. It's fintech, health tech, food and agri-tech, and logistics tech. Many people have asked, so I'm just pointing out. I want to come back to this question on returns and time horizon. The next question that people ask us, and to an extent you've already answered it, Rahul, is that many first-time investors in VC funds are struck by the long time horizons. And we've been also trying to explain to people how, like you just described, that incremental value uptick that comes from 6, 7, 8 years in a segment of the portfolio is disproportionately large, right? So it creates an asymmetry almost potentially, and therefore
Right.
that time horizon is necessary to unlock that value quite fully. I mean, I'm not trying to answer the question, but this is what the conversation sounds like when we talk to our clients. Can you just talk through this point a little bit more also? When do you expect distributions? Because it's not a typical PE fund, which might start seeing distributions sooner. And also we get asked, about the comparison to pre-IPO funds, which have a little bit greater pro-cyclicality, I suppose, a massive pro-cyclicality, and are topical, right? So people are seeing that. So could you and Bala maybe just cover off these points in the context of the time horizon, and then just something on the pre-IPO fund comparison?
Let Bala take the first one. I can talk about the pre-IPO comparison.
Yeah, I think, look, Rahul touched upon some of this, but I think it's really important to understand the construct of any VC fund. And if I were to take that same example again, it is very rare, it happens, but it's very rare that you invest in a company that's a winner and somehow that valuation stops at $1 billion. Okay, so we use $1 billion and a unicorn as a benchmark, which is somebody gets to, $200, $300 million in revenue, they become a unicorn. But that's nothing but a marketing term. What actually happens in VC firms, the very best VC funds are your top 3, 4 companies are not just 7 baggers, 8 baggers. They're not even 10 baggers, okay, 10x. Usually they are 15x, 25x, 65x, because that is the way the asset class behaves. We are looking out of 18 for 3, 4 companies that by year 5 or year 6 have reached that inflection point where anything can happen from there. We're already very well covered in terms of returns, maybe 7 or 8x. But at that point in time is where the value for the money comes from the fund manager whom you have assigned your money to, because we have a very important portfolio decision to make, which is, do you hold or do you sell? And even today, Rahul will tell you there are companies that many VC funds are holding even at the IPO level, because you believe the upside is even higher. So when you compare this to any other asset class, you're not talking about 10% a year or even 15% a year. These 3, 4 companies disproportionately return the fund many times over, and that is what we are aiming for. So 2 things related to that, and I'll hand it over to Rahul. One of the reasons you see this re-rating in India is, with the technology changes, there is a massive opportunity for tech-based entrepreneurs and founders to rethink various markets. Okay, so for example, we were discussing this morning, we are talking to a startup that can potentially redo the way all manufacturing companies hire blue-collar workers, using a QR code, using a digital ID, using the way they kind of search for those workers, the way contractors come in. They could completely rethink how workforce management in India works digitally. That company has 100 million worker opportunity. If they succeed, is it worth a lot of money? Absolutely, because they're going to be very profitable and they're going to own that market. So we are looking for that kind of outcome. And as a result, I think a lot of these are more back-end loaded, but you should start seeing returns from year 6 in terms of distributions.
Sure. I think that's a pretty clear answer, and reiterates the points that Rahul was making earlier as well. Rahul, you wanted to cover just a minute on, you're on mute.
The portfolio is going to be a mix, already is a mix of Series B and Series A's. And that's by design, because we want to stagger out the exits. Series B's for us should exit sooner, 4 to 5 years. A's should take 6 to 7 years. So that's the expectation. There are always some down cycle years, demon might happen, something IPO window might close. So some things keep happening. So budgeting for some more one odd year for these misses. On the comp, see I believe that the current window or the current selection set for pre-IPO companies is limited, which would mean that there is it's almost like the mutual fund industry where the large caps are what finally, same stocks will be in every large cap fund. And that's not an ideal way to diversify. There is talks of significant capital raised to, to actually take care of the growth of these companies going forward. But our view is that this is not yet a point where it can translate into a fund opportunity. Yes, if you're getting a piece of a company, you can do a deep dive. I mean, we take calls from investors from around the world. They may be friends or HNI family friends who would basically want to know, okay, tell me about delivery. What do you think about? So they are, being shown an opportunity by a bank to look at only delivery as an asset, as a investment, not a basket, because a basket is not big and you cannot evaluate a basket. You just have to assume it's well diversified. So I think that's the issue. Because what's the look to do ratio? In our case, the look to do ratio, as I said, is 1%. We look at 800 companies, we'll do 8 in a year. The look to do ratio in an IPO is, I don't know. I mean, it's there are just not that many companies to look at and select from. So how do you build a portfolio? So I think it's an opportunity which can take away some hassle of getting into these late stage opportunities, but it's, I don't know if a fund is justified at this point.
So I think, look, we're essentially comparing two different asset classes. The universe is different. The investment strategy is different. The cyclicality component is different. But, I guess you've brought that out very much more eloquently by taking examples of investors thinking around, how they access these opportunities. Look, we've got a lot to cover, which I'm afraid we won't be able to. We have only so much time. We've got a very engaged audience with lots of questions coming through. What we're going to do, and this is for our guests, is some of the very specific questions around specific sectors, etc. We'll make a note of those, and we'll respond to them separately, because I don't think we'll have enough time here. And for some people who are actually contemplating investing in the fund, we'll set up time with Bala and or Rahul to have a conversation where you can drill deeper into some of these questions as well. What we wanted to do was also introduce you to one of their entrepreneurs. They say early stage investing is about talented teams with big dreams. And so we have one such hugely talented individual joining us. His name is Arjun Ahluwalia. He's the founder and CEO of Jai Kisan, a tech platform which is focused on providing financial products to the underserved, as it were, rural economy. And it's been in the news recently with the 30 million Series A investment from a clutch of marquee investors. Welcome, Arjun. Thank you very much for taking the time to join us. What we're going to do, we have another half an hour or so. We'll ask Arjun to tell us a little bit about the Jai Kisan story, his story, Jai Kisan story, and then maybe we can ask him questions. So we'll open up the floor to questions. After 15 minutes or so, and then we'll try.
And I can also give our background, Shiv. We met Arjun for the first time in March of 2020. We liked the market that they were going after. We spent time with Arjun to understand how they were going to, think about executing in it. They were obviously much smaller at that point. There was a lot to be proven, and we invested. We decided to invest in May. And we closed the transaction in, I think, late July, if I'm not mistaken. So our money actually went in sometime in July last year. And the growth from there, I will let Arjun cover it, but it's been quite phenomenal. So, we are obviously very happy with this investment. And I think it's one of and especially when Arjun describes it, it's great to hear from him what's the journey been like, and that too in a massive sector like agri. So Arjun, thanks for being here.
No, that's great to hear. And Arjun, of course, you can be very candid about your conversations, relationship, and as it's evolved with Rahul and Bala as well.
Oh, absolutely. And thank you. Thanks a ton for this. Glad to be here and looking forward to an engaging discussion. I think obviously a lot of us here have had a very, very interesting past 1 year. right? And especially the ones who've been blessed to kind of be in the overall technology domain, especially focusing on rural parts itself as well, because that is what we've seen has kind of carried the economic growth and the torch over the course of the past year. So the journey has definitely been quite something. We've learned a lot, we've grown a lot, and we've evolved a bunch as well, both personally and professionally. So I think just to kind of give some background around Jai Kisan, myself, my co-founder, and things like that. I'm from Mumbai, from India. Went to college at Texas A&M, which is practically the largest agri university in the world, post which I dabbled in VC investing in Palo Alto at Silicon Valley Bank's VC arm, and then moved to private equity, working and investing in FIs, food supply chain businesses, and some energy infrastructure stuff across the globe. My co-founder is one of my best friends from college, who I met literally on the second or third day of college. He's originally Filipino, but of American citizenship, born and raised in the US. Comes from a very, very agri background as well, where his family has significant agri assets in the Philippines, and kind of was very first-hand towards this problem as well, around agri financing and things like that. He worked at Alvarez Marsal in the private equity restructuring practice between Houston and New York. So I think, the point when we decided to make the jump was when, I was back in India, and what I kind of kept seeing was that my maid could walk into a store, right? Any electronics store in Mumbai city, and she could just walk out with an electronic item financed with minimal documentation at 0% interest rate, right? That was phenomenal. And what that has done has created practically the largest non-banking lender in the country, called Bajaj Finance, but also made the smartphone manufacturer, which practically none of us had really heard about 5, 7, 8 years ago, called Xiaomi, to become one of the largest or the largest smartphone manufacturer in the country. And what does that show us? That shows us that the marriage of commerce and financing can be an extremely powerful tool to be able to sell through the merchant outlet for the customer, especially in a country like India, where even in the most urban parts of the country, we are taking interest-free credit from our milkman. Right? And what that means is that, living in South Bombay also, my milkman is paid at the end of the month. And if the poor guy decides to ask for cash in the midst of the month, he's given a simple option that we'll move on to another milkman. Any of my colleagues right now, if they go downstairs, buy a bottle of water, buy a pack of cigarettes, buy a bottle of Coca-Cola, will literally tell the guy, hey, khate mein dal dijiye. Now, interestingly enough, if the merchant in urban India says, nahi dalunga, you will just jump him and go to the next merchant and get him to put him in the khata. And hence what you see in India is that merchant credit is an expectation by the customer. It's not a value-added service. So merchants in urban India cannot charge a premium for the item they're selling just because there's so many of them selling the same thing. Whereas in rural India, there's a significant disconnect here, where there's one merchant and a significant demand base relying on that merchant. And thereby that merchant, while they're continuing to give credit, they're able to charge a disproportionate fee for being able to provide that particular service. And, going back to the example of my maid walking into kind of, an electronics store and getting, a Xiaomi cell phone fully financed. A farmer in the middle of Nilgiri Hills, she needs to go to a bank branch, apply for the loan, wait for 20 days, give her collateral, wait for 10 more days, finally get the loan disbursed, and then go to the input seller to buy her seeds. Why can't we give that entire value proposition or offering straight on the spot at the same place, right? And that was this hypothesis that we kind of came in with, people who've kind of worked across the globe and things like that. And I think what we realized was that, hey, we need to get some sort of first-hand experience. So we quit our jobs. We moved to a small village in Maharashtra called Tarabad, which was close right outside. We took a store right outside my friend's sugar mill, and we started selling things to farmers. What we realized was our hypothesis started coming true, because 70% of the people who would come into the door, despite not knowing us or we not being there for the past number of generations, were still asking us for some sort of credit period days, right? At which point we kind of realized that our hypothesis is falling in place. So that's when we kind of did a few pilots, moved back to Bombay. We raised our first round from Bloom whom Mr. Mariwala, a bunch of other HNIs as well. And we started building out tech to be able to integrate in the right manner with financial institutions to further facilitate this capital through a merchant outlet to be able to procure any sort of income generating item or make any sort of income generating transaction. Right? And we kicked off in December 2019, January 2020 with our first lender partner. Right. So I think when we came knocking on Rahul's door, we were at a level where we were about 27, 28 crore rupees disbursed in totality in those 4 months. And I think the max number that we had hit was about 11 crores on a monthly basis. Right? And obviously then came COVID, yeah, and lots of things kind of changed for the good and the worse, right? And today we've come a long way through where we are practically disbursing almost 50 crores on a monthly basis. Right? Bharat Khata, which was something that was in its infancy or had just launched when Rahul had kind of invested in us, has now generated traction of over $450 million GTV transacted at an annualized level. Right? And today as a company, at our bottom line, our revenue number, we are sitting at a 4 million recurring revenue rate, right? And that is where we are in the past, 14 to 16 months of our growth story. From 50 people, we are 200 odd. And over the course of this year, we look at disbursing anywhere between 1,000 to 1,200 crores as well. Right, we've started now running our own book also in parallel to what we do with financial partners to be able to make sure that we are getting the right financial products to our demand side partners and to be able to take it from there. So, to kind of stitch it all up, what we are building is we are building a next generational platform like an Affirm in the US, but looking to gain visibility on every income generating transaction happening in rural India, and thereby through that visibility, be able to provide financing around each of those income generating transactions by building the following modes around viral acquisition, superior underwriting, and number 3, to be able to actually build a solid bottom line because you're getting visibility and a closed loop ecosystem because of the transactions that are taking place on the digital ledger called Bharat Khata. So I think I'll take a step back, Shiv, and this was just a quick kind of a summary to try to show also the performance, but also the business to the group, and happy to kind of jump into any specific questions as well.
I guess, congratulations on the progress you've made. Clearly, there's a long way to go in this transformational story that you're trying to create, but it is problem solving like this, which is going to result in that force multiplier that we've been talking about in the course of the session earlier. So yeah, congratulations on getting here. Maybe I can just kick this off with a couple of questions and then we can open it up to the floor, or it's anyway open to the floor. When you were looking for investors and you invested with a few people, what was it, which are individuals as well as institutions, what was it that clicked with Arkam? And how did you think about that, and how's that played out in terms of your conversations around the strategy and the evolution of the company?
Sure, absolutely. And I think there, Shiv, would love to kind of give some background as well as to, we've been relatively particular about the type of investors that we get involved into the business, right? When we are able to, obviously. Now, in our first round, we obviously kind of got Bloom involved. Bloom is based in Bombay. It was very convenient. We knew the guys from before, right? Ashish, who's involved with us, is very, very kind of hell-bent on building profitable companies, right? And at the same time, HNIs like Mr. Mariwala, etc., who could be strategic to the business. In our next round, what we wanted to bring was 2 institutions, one extremely financial investor heavy, right? And the other was a strategic. Yeah. And I think we found the best of both the worlds in our previous round, right? Where we got introduced to Rahul and kind of understood his background with kind of being one of the earliest VC investors in the country with Helion, right? And being able to kind of see, cycles go forward, right? Which is something that we didn't see in many, many, many VCs, right? And what does that give for a founder or a promoter, right? One of the most important comfort items, which is that the investor will be empathetic to you or with you when you will see the down cycle, right? And I think that was the founding establishment, to kind of start engaging with Arkam. What we realized, through this entire partnership was also the following: is that his involvement in early enough in traditional businesses, right, which were in the financial or BFSI domain, and having gone public was something that we really valued. And both Adriel and me, being relatively young promoters and young founders, is something that we wanted guidance around, right? As we kind of build Jai Kisan, but also at the same time build ourselves to be able to run eventually a public company. Yeah. And number three, I think, is, a lot of VCs kind of focus around putting the foot on the accelerator, right? Now, while that is great in non-lending businesses, right? In lending, you only realize that that's bad when the accelerator gives up and your car kind of goes into a short circuit with the engine blowing up, right? And that is where you need to have people who have the right lens to be able to slow you down and show you the right risk metrics, which they've been able to gain insights around over cycles, right? And that is, again, something that I think we saw significantly with Rahul, right? And I'll give you an interesting example, right? I think when we closed the deal with Rahul, it took us about 60 odd days, right, to be able to kind of do that. This time around, yeah, we did it from term sheet to SSA, SHA in about 30 days. And a large reason of that was Rahul's first 3 months after investing in us and saying that, hey, data needs to be in place, right, in particular different ways. And I think that is something that we really kind of benefited from. So this was the financial investor angle to it. And alongside Rahul and Arkam came NABARD as well, right? And NABARD, obviously being practically the largest financier in agriculture in Asia Pacific, became a very, very interesting thing for us strategically. And we were also their first ever investment in India in the private domain. Right. So I think the combo of these two kind of coming into the company significantly help accelerate everything that we have done over the past 12 months as well.
Excellent. Rahul, would you care to comment? I know you already talked about Jai Kisan and how you thought about it when you were getting into it. But based on what Arjun has just said, are there any further observations you'd like to add to that?
Yeah, see, the size of the market opportunity was very clear. What we knew from experience was that there wasn't any private startup that had gone and started attacking the market. It's a very attractive market from that sense that, you go in, there is no, elbow pushing on, here's, 5 other startups trying to get to the same customer. So there is time to build, in a measured manner instead of, throwing money at it. And you can follow a path where you're profitably building a business model. You don't have to, necessarily choose the path of, the customer acquisition, high customer acquisition cost. So we like that. The uniqueness of the business model is what really got us sold. Obviously what Arjun put together in a very short time period was the validated model where multiple parties were involved in accessing this opportunity, right? It was not if there's a nail, just go hammer it. It was a very sophisticated hammer. And that was that there was, for the first time, I was seeing end use, or at least influencing the end use of that loan into the productive use that it is intended to be. I mean, it's not going into buying a motorcycle or TV. It's going into producing something which will then help in repaying the loan. Rural economies have, I've done a lot of microfinance in the past, have this basic problem that, there is no productive loan. Income cycles determine repayment rates unless you have a very strong social structure. So here there was, for the first time, it was, you put this money in, there will be an output and that will come into repayment. So being able to measure, monitor. Second big innovation was the role of the manufacturing partner or the big industrial partner that wants to not reach it. The underwriting opportunity, but does not have the experience and the data to evaluate it. So things like, you are lending now across so many crops, so many regions. You build your data models around, what is the soil like, what's the weather like, what's the, expected production going to look like. So specialization is an important part of, of an agri lender, which, Jai Kisan is doing it with tech. And, of course, they build the LOS themselves, the LMS themselves, the underwriting engine. So they build the entire tech stack themselves. So I think that this was the uniqueness that really attracted us to Jai Kisan very early on. I think we just came with the knowledge that the market opportunity is big.
Excellent. Looks like it's going very well. We have two questions from Mr. Rawat. One to Bala, which is, do you have second thoughts about any of the companies you invested in? I'm taking it you've invested in them quite recently, but I'll wait for your answer. And the second is to Arjun around the quality of the loans themselves. Mr. Rawat asks, can you shed some light on the collection and quality of the loan book, the impairment? How do you actually expect it to play out? So perhaps Bala, you can comment on your confidence in the companies that you've invested in first, and then Arjun can comment on the quality of his loan book.
Yeah, no, I actually think the direct answer is no, because it's too early. These are 10-year cycles, and we picked these companies based on a fair amount of thought in terms of the market and what they need to do. Now, if a later stage company that we have picked, is floundering, that's a bigger cause of concern for us because, they have reached a certain level of product market fit and you're expecting a certain scale. That's usually a sign, but generally speaking, these are all, there are problems in all our companies. There are ways to deal with those problems and the founder quality shines through there and we kind of work with them. But are there environmental factors in some sectors that are not great? Yeah, I think, for example, it's gotten a lot better now. Last year, BestDoc, our healthcare SaaS company, they had 50 or 60% of their sales team came down with COVID, right? And their customers wouldn't see them because hospitals are really, they got better things to do at that point in time and everybody is struggling. But these are all, we view them as short-term setbacks and the companies kind of come back this year in terms of their hiring, etc. But otherwise, it's a long-winded answer of saying, no, we have no regrets going further.
We are taking that as a given, I have to say, given it's less than 2 years, as you said quite rightly, but it's good to hear it in more detail from you. Arjun, would you like to comment on just the quality of the loan book? What is the kind of impairment that you see?
Sure. And I think I'll just quickly combine it with someone who's also asked a question on the chat around the risk in giving loans to agri businesses, right? So just to kind of give you guys quick numbers, right? May end disbursed some 250 odd CR over the past year. NPA is sitting at 0%. Delinquency is at 0.89. .37%. Why is the book performing like this, right? And why is it performing well enough to the point where last year in April and May, when our banking partners had pulled back disbursements with possibly every fintech that they worked with, even the ones that were probably 100 times our size at that time, they continue to disburse money with us. Because at the end of the day, each of us on this call stopped buying all sorts of items in April and May last year, but we did continue to eat, right? And my partners, interestingly enough, like the big baskets, the Ninja Carts, the Way Cools, the Nature's Baskets of the world, ended up making a higher net margin, right? And when I say net margin, that is net of the increase in logistical costs or stress costs due to lockdown. And that is what you see, that when you actually participate in relatively closed loop value chains that also have a little bit of sprinkle of tech on them, they are able to very quickly adapt. Yeah. And where people are able to produce. On the other side, on the sell side, yes, we did see disruption where on the asset financing business, we saw 4 or 5% of our farmers ask for moratorium. which was something that they didn't need to ask for, which was actually blanketly given, right? And I'm sure many of us actually availed for it from our business units and entities and things like that, right? But each of those farmers, dealers actually came in and said, we will service that EMI, please keep the business going. So that is how much value proposition a merchant saw in the, in Jai Kisan's, offering to them, that they were willing to be able to kind of, substitute this particular EMI on behalf of the farmer to help regularize that particular loan as well. We didn't take or avail of any moratorium from our lending partners, and we actually got top 15 of our anchor partners, who are the kind of names I just took, to actually sign waivers on behalf of their borrowers as the anchors and the guarantors to the moratorium as we continue to lend to them, right? So I think, the essential nature of this industry is what has significantly helped us. A lot of people ask us that, hey, what about a farm loan waiver, right? I think post-COVID, I have the perfect response to that. We survived a moratorium. Yeah, which was given to everybody. It was just not a farm loan waiver. And I think that is where bringing in this cushion or this layer of a B2B2C strategy significantly helps to be able to reduce the risk and the pain that will come in from the customer directly to an entity like ours by the merchant or the anchor or the guarantor in the middle that kind of plays out.
Okay, Arjun, we have a question from someone asking about your entrepreneurial experience being in the driver's seat. What has been being accountable for all the decisions in a way that you're not within the corporate guardrails and everything is down to you and probably your co-founder Adriel. So, can you just talk about that experience a little bit? How does that work for you?
Sure. So I think, obviously kind of being in this domain and being in kind of a high intensity role, right? Which is something that luckily we were both decently exposed to in our previous job roles as well, right? But here, obviously, every decision is coming back and impacting you directly and your vision and your mission. Right. So how do you kind of percolate that to the 100 people that are there in the team or the 200 people today that are in the team, right? So that each of them can get accountable and responsible through the process. But I think through all of this, maintaining sanity is extremely, extremely important, which is something that comes in by having the perfect ears or the listening ears to kind of reach out to, right? Who are empathetic enough with you. And I think there, this sounding board that we've created around us or ring-fenced ourselves with, right? One of who is obviously also Rahul, right? Really significantly helps where, they have seen this happen multiple times with multiple founders. And for that insight to be kind of delivered to you and saying, hey, XYZ, for example, right now in India, there's this major problem, right? Where tech guys don't show up on the first day of work, right? And they forget that you've given an offer to them, right? And they're like, hey, we've joined somewhere else, blah, blah. So initially, when we were much younger, we were like, is this a problem that only we are facing, right? Eventually, you kind of start thinking, hey, what are we doing wrong, which is so bad, right? That these people are not coming in. And then you realize the threats of the world are, kind of facing the same problem, right? But how do you find that insight? Yeah, is through the sounding board that you've kind of built around yourself, right? And that's a practical problem that has nothing to do with you in isolation, right? It is a macro level kind of a problem, and this is something that everyone needs to work towards, right? And let's kind of crowdsource as much insights as we can to be able to do so, right? So I think this is how we try to deal with most of the problems that we are able to deal with.
Sounds like you have a nurturing ecosystem, as intense as it might be. And they also say entrepreneurship is a good way to strip away the inessentials. When you look deep within yourself, I'm hoping that that's your experience as well. We're going to be running out of time very soon. What I'll do is I'll maybe just ask one or two more questions that have come through to us before we bring this to a close. There is a question for Rahul and Bala, and Arjun, you're most welcome to chip in as well if you like, saying that since you guys are essentially tech investors, what is in short, can you just say what the most exciting technology that you're looking at right now? And if you think that blockchain technology it is, then you're most welcome to comment on cryptocurrencies as well, without fearing the controversy that might erupt based on what you might say. So, let's just shorten it. What's the most exciting technologies you're seeing right now? I think, given the way you scan your universe. Rahul, maybe you could start.
I'll let Bala go. He's actually recently spent time with a very exciting tech company.
Okay.
Yeah, one that flies.
Yeah, and I think, at a broad level, what we are really seeing is, and what is also a barrier to entry for many existing businesses versus new age founders and companies, is the intersection of technologies. Okay, so for example, you're going to see a lot more companies leverage a combination of AI and ML on the inside, but with a lot more, shall I say, anything as simple as QR code to IoT to AR, VR on the outside, right? So how do you stitch everything together into a business process is really what makes it very unique. The company that we evaluated recently is actually a autonomous drone technology. And this is a company that combines machine learning with GPS, with flight controls, with autonomous flying, which means the minute it takes off, it thinks on its own. And for example, this company, this drone is being evaluated for use to drop off shipments to the Indian troops in Siachen. They have the ability to create an air ambulance where you can fly into rural areas to pick up people and come back. This is like incredibly difficult technology, and is probably one of the top 25 teams in the world. So that's the best I've seen so far this year. Very exciting though. And it's all made in India.
Makes it sound even more exciting.
Yeah.
Rahul, would you like to?
Yeah, nothing that comes close to something as fancy as this, but I think more on, I think we feel technologies come and go. It's more like a theme of the day. Good technology companies will adopt and customize it and move on to, to whatever is coming next. So it's always a alphabet soup of technologies inside the company. It's, nobody really, but we don't go out looking for tech, right? It's not like we go look out for AI, ML or drone for that matter. We finally look at, what is the value that it is producing, and, is it long lasting value? So that's obviously something we try and avoid, which is to get excited with just new age tech.
Excellent. I'm afraid we're completely out of time. There are many people who are interested in specifics of the fund. We had also wanted to cover some questions around, co-investment opportunities. I'm wondering if you can just cover that before we then just close it. And Rahul or Bala, either of you could just take this. Some of our clients have been asking specifically around whether they can co-invest, because a lot of people do get direct investing opportunities. And thinking about doing it through the fund route versus doing it directly. And in the fund, can they co-invest? If you could just cover those off.
I'll also cover where we are on the fundraise. So we are raising 700 crore. We have about 550 committed, another 120, 130 signed up with institutions, which will be onboarded soon. So we are almost nearing the final close of the fund. We expect to be oversubscribed. The part about co-investment really is it's a pretty tough market in terms of, it's very competitive. I think some of the questions were about how do we differentiate, and situations where of course there's room, as long as you're investors in the fund, we'd be happy to to get your interest to look at something together. Usual challenges are your response times versus what the deal is giving us as the response time. If it fits in, it's great. But we can always, take in, any specific interests that any investor has to directly come into a company. And if there is room, then we can certainly influence the founders to consider that, especially again, if there is a good fit. If somebody's got an industry background or a business background that can add value to the business, it's always much better to make the case. But so far, we don't have anybody who's officially a co-investment partner. But from that viewpoint, the first criteria is to be part of the fund.
Excellent. As I was saying earlier, I think there are more questions that relate to the fund, but for those of you who are more interested in delving a little deeper, obviously talk to your relationship managers, our product people, and we will also set up time with Rahul and Bala if you want to get even further into that conversation. I want to thank all our guests for taking the time to attend today, and to our speakers, Bala, Rahul, and Arjun, for really engaging conversations, real good insights as well. So very genuine thoughts around some of the issues that this being in the sector involves. And clearly there is a huge change that's underway in this startup space. It's not linear. So I think we all look forward to the witnessing this transformation that we've already been seeing, but what it has in store in the years ahead. But in the meanwhile, thank you very much to everyone for joining. We'll bring this call to an end now, and we wish you a very nice evening. Thank you.
Thank you, Shiv. Thank you for having us.